Hello and welcome to Portfolio's Markets Checklist, week 103. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research and consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
Thank you, Richard. Well, it was a pretty quiet week. News. So the Bank of Japan found a further way of easing monetary policy by essentially lending to banks. They previously lent to banks at a fixed rate of 0. They're now going to lend to them at variable rates, including negative rates. And that will pump the Japanese banking system full of cash with the idea that the banks will then go and buy Japanese government bonds. Now, you know that the Bank of Japan is fixing the Japanese 10-year rate at 0.5%. and has essentially bought 100% of 10-year bonds. Well, this is a way of reducing their own need to buy JGBs in the market by getting the banks to do it for them. And they have succeeded in squeezing the bears. Now, the Bank of Canada raised interest rates this week to 4.5%, and has now said it will pause. Now, we'll show you a chart in a minute. The Bank of Canada and the Fed have been raising rates in lockstep. And now the Bank of Canada is pausing. Will the Fed pause next week? Now, previously, we were expecting the Fed to raise by 0.5%. The market is increasingly confident that they'll raise by 0.25%. We'll have to wait and see. Elsewhere, India has overtaken China to become the most populous nation with 1.4 billion people and growing. And finally, US Q4 GDP slightly beat expectations and came in at a solid 2.9% annualized. Some charts. So this is the Bank of Canada and the Fed interest rates, and you see they've been moving up in lockstep. Now the Bank of Canada is pausing. Richard, what do you expect the Fed to do next week? What would you do?
I think they'll raise, Keith, because I think if they don't, they lose credibility. The economy is, from their point of view, the economy is doing quite well. They're not on top of inflation from the way they look at it. So yeah, I think they'll raise. Do you think that?
Well, the question is, will they raise by 0.25% or 0.5%, and then will they pause? So I think, so the market's assuming they're going to raise by 0.25%. If I was the Fed, I would be raising by 0.5%.
You give the market a shock.
Yeah, I think it's
reacting. The market is not behaving as if interest rates are going to continue to rise, is it? I mean, the overall sort of sense is that things are buoyant. There's a lot of optimism around. So
exactly, I think it'd be an easy win for the Fed to raise by 0.5% and to show that inflation targeting is their priority.
Yeah. I agree.
Well, next week we'll discover whether the Fed listens to Portfolio Matters or the market.
Surely the answer to that is obvious.
So this is Japanese bond yields, 10-year bond yields, and you'll see that the actions of the Bank of Japan have succeeded in stabilizing the Japanese 10-year below 0.5%. This is US inflation, and you'll see that the market is expecting inflation to come down very quickly in the second half of this year. And the Fed to raise rates by less than 50 basis points before peak, and then to cut rates rapidly starting later this year. But quick reminder, the market's forecast for what the Fed's going to do, in fact, the Fed's forecast for what it's going to do, are always wrong. So the one thing we know is not going to happen is that. Okay, and on to this week's economic data. So we had UK consumer confidence, and that was very poor. It was expected at -38 in January. It came in at -45, down on expectations and down on December. We also had UK retail sales for December. They were disappointing, expected at plus 0.2, came in at -1.1. The UK economy is not doing well. And as further evidence of that, the public sector borrowing for December was much higher than expected. It came in at -26.6 billion when it was expected at 17.7 billion. We are borrowing much more than pre-COVID, and we seem to have no plan for getting that under control currently. We also had the S&P Global PMIs for the UK, Europe, and the US. So for the UK, in January, the manufacturing came in at 46.7, which was up on both expectations and December, but again is still in contracting territory. Services was very poor, came in at 48, missing expectations and down on December. And so the composite came in at 47.8, again missing expectations and down on December. The UK economy is not doing well. In the EU, consumer confidence came in at -20.9 in January. That was up slightly on December, but missed expectations. So the market is currently getting very carried away with the idea that Europe can escape a recession, but the bounce in consumer confidence and in the PMIs is really quite weak. So moving on to the PMIs, manufacturing PMI came in at 48.8, which was a bounce on December, but is still in contraction territory. Services came in at 50.7, which missed expectations, but was up on December and crucially above 50. The composite was at 50.2. So the EU PMIs are portraying a European economy which is hovering around flat, neither growing nor contracting. In the US, the manufacturing PMI came at 46.6, which was up on December, beat expectations, but is still below 50 and in contraction territory. Services PMI was the same at 46.6 and the composite at 46.8. Now, all of those were up on December, but still below 50. The US economy is not doing well either. A surprise, though, was US durable goods orders, which rose 5.6% month on month in January. Much better than expectations and December number. We also had some quarterly data. US GDP in Q4 came in at plus 2.9%, which was better than expected and slightly down on Q3. The US economy in Q4 was pretty solid, frankly. We also had the Fed's favored measure of inflation, which is personal consumption expenditure. Quarter on quarter in Q4, that was 3.2% annualized, and core was 3.9%. So both of those are reassuring, down on Q3, and crucially, the Fed has stated that it wants to have positive real yields at the peak of this cycle, and it has achieved that now. So reminder, the Fed funds rate is between 4.25 and 4.5% currently, and PCE inflation is running at 3.2% or 3.9% for the core. So it's got real interest rates, positive real interest rates. Some charts, Richard.
Thank you, Keith. UK consumer confidence, as Keith has reported, it's not looking healthy at all. And UK retail sales without fuel declining month on month. The UK factory orders, very significant drop.
Yeah, they look terrible.
They do. UK public sector borrowing. I think we saw this chart last week, or we saw the chart last week, but I'm not sure if it had the final bar on it. That is looking pretty dreadful. Manufacturing PMI is ticking around, sort of slightly contractionary, and the services PMI has just fallen below 50, and the composite PMI is below 50, falling. So overall, the UK is painting a rather gloomy picture. EU consumer confidence, having been incredibly low, is now climbing.
Yes, but still terrible.
And the EU manufacturing PMI is trying to head back towards 50. And the EU services PMI bouncing around 50, so neutral position. And the composite is around about 50. So US GDP, it's just got it's steadily growing, isn't it? It hasn't gone into recession.
Yeah, it's been resilient.
And as Keith, Q4 GDP was resilient. But PMIs have fallen sharply, and the question is the US GDP in the next few quarters going to follow PMIs down to being negative? Existing home sales just showing continuing fall, but not as bad as in December. So US existing home sales have fallen precipitously and showing no sign of increasing. They're down around about the 2010 levels. So that's a poor sign for the health of the US economy. And there's US global services PMI below 50, the manufacturing PMI well below 50, and the US composite PMI below 50, as one would expect. US durable goods month on month is orders. It's very very strange. It's a big change, isn't it?
Mm. Yes, actually, I've just realised that in the table I have these numbers for January. They're not. They're for December. So the big pickup in durable goods orders was for December.
And the retail sales, US retail sales year on year, continuing to follow the decline that they've experienced since the summer.
Mm.
And US inflation quarter on quarter annualized, continuing to fall.
That's reassuring.
Yeah. And core PCE inflation annualized also falling. So the Fed now has achieved positive real interest rates. And the US Conference Board of Leading Economic Indicators is suggesting that the US economy is slowing.
Yes. And crucially, it's at a level that's generally associated with a recession.
Yeah. As Keith says, it is a good forecaster of coming recession. So the black line is below zero. The light blue line is likely to head that way. The US 30-year mortgage rates are dropping, from taking a little bit of pressure off the housing market. And the mortgage purchase index has bounced, actually, hasn't it? Quite significantly. It's low.
Yeah, I wonder how much of that is just seasonal. You see, in 2020, there was also a big spike in the first month of the year.
Yeah. US new home sales, they're okay. They're not as high as they have been over the last 2 years, but this is not a shabby number in the context of 2016 to 2020.
No.
US initial jobless claims are continuing to fall weekly.
Yeah, the jobs market continues to look tight. If I was the Fed, I would be seriously considering raising by 50 basis points, frankly.
Yeah, I think you're right, Keith. And the continuing jobless claims have plateaued over the last 6 or 8 weeks. So sadly, we have to conclude the UK economy is struggling. Retail sales falling, PMIs contracting, public sector borrowing requirement rising alarmingly. The EU appears to be in a better position than the UK. It's recovered slightly from its lows. Its PMIs remain around about 50, so it's on the cusp of growth, no growth, and consumer confidence very poor, but has improved significantly over the last month. US economy seems to be in a different place, growing healthily in Q4. US PMIs have bounced. We don't know if that's a trend, but the leading indicators continue to decline, suggesting that the US may be entering into a recession stroke in one, and we might see GDP numbers below zero in the next couple of quarters, and US inflation is continuing to fall.
Thank you, Richard. Well, sadly, we're now on to errors and corrections, because last week we did a section on Japan and I misinterpreted this chart. Now, we know that Japanese interest rates are much lower than the rest of the world, and 10-year JGBs are yielding 0.5%, where the equivalent US is at over 3.5%. So hence, I was expecting, and I interpreted this chart to show outflows from Japan and purchases of foreign bonds. But actually, it's the other way around. And thank you to Jeff Prince for his correction. What's actually been happening is that Japanese investors have been taking advantage of the weak yen to sell their foreign bond holdings and repatriate capital. So buying cheap yen and selling successful investments in overseas bonds. Now, the fear was that continued weak Japanese monetary policy lead to further weakness in the yen, and it would exacerbate selling of foreign bonds, but that has not happened. Now, over the last few weeks, the Bank of Japan has massively increased its QE program, buying unlimited amounts of JGBs, with the net result that total central bank asset purchases have gone positive again. So while the rest of the world is doing QT, overwhelming QE in Japan means that net, the central banks of the world are pumping liquidity into the system. And that is a big change from just a few weeks ago. You'll see the first couple of weeks of the year, we had net falls in total assets of the Fed, ECB, and the Bank of Japan. That's the yearly percentage change. In the US, QT continues, and the Fed balance sheet has fallen by around 476 billion from its peak. But despite Kuroda's new and innovative ways of pumping the Japanese economy full of cash, the yen has recovered and has risen from 150 to 130, and this week's events have not caused a big sell-off. So in summary, massive Bank of Japan QE has more than offset QT in the rest of the world, with the result that the central banks of the world net can and have resumed pumping money into the world economy. But that monetary largesse does not seem to be leaking out of Japan. The yen has actually strengthened over the last few months. Okay, and on to one chart. And this is a great chart from Robin Brooks on Twitter. And what it shows is exactly how higher interest rates slow the economy. So the blue line is residential investment, and the red line is fixed asset investment. And as interest rates rise, so the cost of new projects rises and fewer of them get done. And so these are the different components of US GDP. You'll see the investment component is falling. The residential construction investment is falling really rapidly, and fixed asset investment is rolling over. Now, if the Fed were to reverse course and cut interest rates, it could turn both those lines back up. But if it's committed to getting inflation under control, and reminder, even though inflation is coming down quickly, it is well above the 2% target. As long as the Fed sticks to its stated aims and keeps a monetary policy tight, then you'd expect investment to keep falling and the US economy to go into recession. On to inflation watch, Richard.
Thank you, Keith. Yeah, so the only new number that we have is the Japanese number, which is Japanese inflation is increasing in December, and they've maintained their bond yield, as Keith discussed, at 0.5%, and they are doing QE. How all of this resolves itself ultimately, goodness only knows.
No, mystifies me how they're going to get out of it.
Yeah, the UK pay growth is uncomfortably high and going up sharply, actually, around about 11% there. Well, the PAYE measure is around about 11%. The average weekly wages is around about 8%. So that is, I think the slope of that line, actually, interestingly, if you look at that slope from around about 2021, it's a steady upward trend that we now have. So price growth for UK services continuing to accelerate whilst headline prices appear to have topped out. And as we looked at before, UK nominal wages are rising quickly.
Yeah, that's not a happy looking chart if you're the Bank of England.
It's not, and it's not even a straight line, is it? It's got a curve to it.
Yeah.
Upward curve. So UK consumers 1 and 2 year inflation expectations remain high, and that makes it that, in order to get those significantly down, the Bank of England has got a lot of hard work to do. And they're notably much higher than in the US, aren't they, Keith?
Precisely. Yes, exactly, Richard. And the Bank of England meets next Thursday. So you'd expect them to raise rates again, whereas the US and Canada can think about pausing rates. On this evidence, the UK can't.
No. Why does the Bank of England expect inflation to drop rapidly back to 2%?
Because it always does.
Oh, yeah. So US M2 growth is now negative, but notice that it's only very slightly negative, which means there's still an awful lot of M2 sloshing around, just slightly less than there was a month ago.
Now, we have a section coming up on US money supply and its consequences.
Real-time wage data in the US is showing falling wage growth. So wage growth, we still have wage growth, but the rate of growth is slower.
Yeah, big contrast to the UK.
Yeah. US rents are falling, but year-on-year rental inflation is still very high. US used car prices are falling quite quickly now, having risen incredibly fast after COVID. And fertilizer prices are following a natural gas price. I think we discussed that a few weeks ago, didn't we, Keith? There's quite a high correlation, not surprisingly, since fertilizer is made out of natural gas. So UK inflation appears to be persistent and establishing itself. Wage inflation still rising. Bank of England has got a difficult job on its hands in controlling inflation, not damaging the economy. Very difficult. The economy is not in a great place. And US inflation is falling. Wage inflation appears to be peaking, and they still have economic growth.
Well, the UK has stagflation. We've got a shrinking economy and persistent inflation. Not good.
Yeah, and high taxation.
Yeah. Okay, on to recession watch. This chart shows the implied odds of a recession imputed from various financial markets. The black bar is as of last October. The yellow bar is as of this month. And you'll see that based on financial markets, the odds of a recession have tumbled. And in the US, financial conditions have really eased over the last 3 months. Although US consumers' credit card interest rates have not eased, they have absolutely shot up. Although the markets seem to be expecting a soft landing and are reducing their odds of recession, when you look at the lessons of history. Whenever the Fed has responded to a spike in inflation by raising rates sharply, a recession has ensued. Pause and take a look. The vertical grey bars are recessions and the blue bars are the Fed funds rate. And you'll see whenever you get a peak in the Fed funds rate, a recession results. And we talked earlier about fixed asset and residential investment, and that is the mechanism by which rising interest rates slow the economy. It just works with a lag, and we are very much expecting tight monetary policy to cause a US recession in the second half of this year. Turning to the Eurozone, well, everyone's getting excited about the Eurozone, but when you look at economists' forecasts for 2023, yes, they're up a bit, but it really is a bit. In the case of Germany, they're still expecting recession this year. The Eurozone as a whole, they're expecting a tiny contraction. Now they're expecting flat. That is not a great recovery. But Eurozone industrial production has been amazingly resilient, given very high gas prices and the invasion of Ukraine. It has not collapsed. It's been flat. Although, when you look at energy-intensive industries, activity there, as expected, has suffered. Now, in the UK consumers are spending more, which is the light blue line, but getting less, which is the dark blue line. Inflation is cutting into UK consumers' spending baskets. They can't afford as much as they used to be able to. Now, in the US, we're getting tech layoffs. So the pink bars are the number of employees laid off. Now, every week we show you the US claimant count, and that has actually been falling. But the layoffs from tech companies will tend to be white-collar workers who won't claim unemployment benefit. So they're unlikely to be in those numbers. And when you look at the percentage of the workforce as being laid off, it's really quite substantial. Microsoft are laying off 5% of workers, Meta 13%, Alphabet, i.e. Google, 6%, Salesforce 10%. These are big percentage cuts in the labor force. And those cuts bring to an end a long hiring spree for US tech. You'll see that in the case of Meta and Salesforce, they have grown enormously in the last 10 years, and they've overhired and are now cutting back. If we look at the NFIB survey, so the National Federation of Independent Businesses, which is small businesses in the US, then the red line is current hiring plans, and it is consistent with other recessions. Small businesses in the US are cutting back on their hiring plans. And if you look at job postings on Indeed.com, they're now down year on year. So we're getting contradictory information. The claimant count is showing a tight jobs market, but elsewhere we're seeing job losses in tech and a decline in posted job adverts. Although you'll notice that these are for white-collar workers. Now, further signs of stress in the US economy are a rise in auto loan delinquencies. They're up 30% year on year. And the savings rate is now at a 70-year low. So US consumers are running down their savings and they're turning to their credit cards to fund expenditure. That does not portray a strong consumer sector in the US. US retail sales are negative in real terms, although they're positive in nominal terms. One positive thing is that after lockdown, everyone is keen to travel, and airline travelers year on year are up 8%. But banks are tightening lending standards. And reminder, the bond market, which has 100% history of accuracy, is forecasting a recession. This is a 10-year minus 3-month yield inversion, the 30-year minus 2-year, the 10-year minus 2-year. All are predicting a recession in the US. Now, there are lots of market commentators saying the US is going to have soft landing and no recession. Well, the bond market, the best predictor, is very much contradicting that. And professional forecasters in the US are forecasting a recession in their greatest numbers ever. And business surveys in the US are very pessimistic. So what all that shows is that forecasters are very pessimistic about the US economy. But what's been surprising is the resilience of the actual data. So is it just that commentators and consumers are more pessimistic than they should be? If you look at this chart, which in the red line shows CEOs' assessment of business conditions, and the black line shows actual business conditions. And you'll see that business leaders are just more pessimistic than the data suggests they should be. Credit spreads in the US are not elevated. If a recession was due, credit spreads should be rising, but they're not. So we're getting quite a lot of contradictory data here. And
just interesting, you know, the subjective objective chart.
Yep.
I mean, I suspect you could say that the subjective is actually a leading indicator, because, you know, these guys, they're very in touch with their markets, and they may well pick up things that, prior to them appearing in objective measures.
Yes, well, that is the assumption, Richard. And actually, if you look closely at this chart, you're absolutely right. If you look at 2009, for example, the subjective measures turned up long before the objective measures did. Yeah. So CEOs were absolutely right in forecasting conditions were going to turn up before they actually did so. But there is quite a big gap now between the two here, where CEOs have been forecasting worse conditions than they really are for over a year. And the market appears to believe that the EU can survive a US recession. So the red line is the probability of an EU recession, and the blue line is the probability of a US recession, which frankly, in this chart, is close to 1. But I just don't see how the EU can survive when the US is in recession, particularly as Germany is such an exporter of capital goods. So, in summary, suddenly the consensus seems to believe that a soft landing is possible, but the economic data in the US continues to soften, and we know that interest rates work with a lag, and it's just a question of time before that tight monetary policy disincentivizes capital investment, leading to falls in GDP. So far, US surveys have been much more pessimistic than the actual data. And as Richard has just said, how much of that is due to the fact that CEOs are forecasting ahead of the actual data, or is it just due to unnatural pessimism? Now, so far, the actual data has been resilient because consumers and businesses have strong balance sheets due to all the fiscal and monetary largesse during the pandemic, although consumer balance sheets are weakening, and there's more on that in a second. But also, companies have been hesitant to fire staff because of their experience during the pandemic. Will that continue? Okay, and on to the US money supply. Now, we showed you a chart earlier that the US money supply growth is negative. Well, a consequence of that is that when money supply is negative and the government is running a fiscal deficit, where is the government getting the money to pay for the deficit from? It's getting it from savers. And so, as long as the US government is running a deficit while M2 is flat or negative, US private savings are shrinking. And this last chart, it was percentage change of M2 on the left and the federal deficit in trillions of dollars on the right. In this chart, which I've created via the St. Louis Fed, it's annual changes in M2, which is the blue line, or the federal deficit, which is an annual number, both in billions of dollars. And you'll see when M2 grows faster than the federal deficit, you are creating private sector savings. And when the deficit is larger than M2, then you're destroying them. And right now, the federal deficit is rising again, and M2 is shrinking. Therefore, you are seeing falls in the private sector excess savings. And this is a forecast from JP Morgan. And the vertical line is June. And you'll see that by February or March, US private sector, US consumers are forecast to have their trend level savings, and thereafter they're going to be below trend. So previously we talked about how the US economy was being supported by strong private sector balance sheets. Well, those balance sheets are eroding rapidly. And so I continue to believe that the US economy is slowing, and in the second half of this year, we're going to get a recession. On to the US debt burden. Richard.
Thanks, Keith. So the US fiscal deficit is widening again, government spending more than it is taking in taxes. US has hit its debt limit ceiling. Government needs to go into intense negotiations in order to raise the debt limit ceiling, and presumably there will be big trade-offs to be had when it does that. But they have enough funds, according to Goldman Sachs, to possibly hold out until August, sometime between August and October. So there's no particular urgency to get it resolved. This is a continuing saga. Every few years, the US hits its debt limit ceiling. There's great angst and a lot of shouting and negotiations. It resets the debt limit ceiling higher. And this graph is showing the debt burden in the US is really getting quite hard to sustain. The total deficit is consistently higher than 5% of GDP. It's heading in a direction which is just getting larger and larger. And I mean, there's a lot of considerations about what happens to the US if it basically can't fund its debt. I mean, basically, obviously, what happens is the US dollar depreciates. But the difficulty the US has is it's living in a changing world to an extent, and there is less certainty about its continuing ability to fund its deficit via overseas markets now than there has been in the past.
Yeah, so I mean, sanctions on Russia have made it clear that, you know, if you hold your reserves in US dollars and you fall out with the US, they will confiscate them essentially. And so you would expect going forward that foreign investor demand for US treasuries will be lower than it was previously.
Exactly so. And this is a sort of thing that is going to evolve over quite a long period of time. It doesn't happen immediately. But I think there is a bit of a changing background to the US being able to fund its deficits. And obviously the interest expense on outstanding debt is going to rise as new debt is issued at higher interest rates. So debt that has previously been issued at a lower rate retains the same debt burden, but new debt that replaces it or new debt that is required for increased expenditure will come online at the current rate of interest. So there's a lot of money in the US's Treasury General account and it can use that money to keep itself going. US government can use that money to keep itself going, which is really why Goldman Sachs predicts that they won't really run out of money till sometime in the late summer. Of course, if the cash comes out of the Treasury General account into circulation, then there's a lot of liquidity going into the US economy.
Yeah, and this we've shown this chart before, which is net financial liquidity and the S&P 500. And actually, spending down the TGA should mean a rising S&P 500, all else being equal.
So currently, the TGA is 372 billion. So negotiations to raise the debt ceiling could be very difficult. Republicans demanding large spending cuts, including cuts to the funding of the war in Ukraine. And whilst the debt ceiling has always ultimately been raised, because of course default by the US government on its treasuries would be catastrophic for the world economy. So in the meantime, the government can get by with its TGA money. And whilst it does so, that should be positive for financial assets. So the story here is that you heard it first on Portfolio Matters. Go out and buy the S&P. Having said that, don't forget to read the disclaimer first.
Yes. Actually, on the US default, I was listening to a podcast which was talking about the consequence of US default. And it was talking about there having been a computer glitch, so 20 years ago, which delayed payments on some treasury bonds. And so although it wasn't an actual default, there was this kind of technical default for a few days. And that raised yields on US treasury bills for about 3 months. So,
Really?
Yeah. So there was a loss of trust.
Yeah.
And any hint of default raises borrowing costs for governments. Okay.
That's what we saw in the UK the other week, or the other month.
Yeah. Oh, absolutely. And briefly onto US housing. So this is new home sales in the US, which have fallen sharply. Now, the reason we're covering this is the Census Bureau has actually revised down numbers for the last 3 months to December. And it has a history of overestimating sales when there are high numbers of cancellations, which we know there are now. This is new homes under construction. Now, so the red is completed, blue is under construction, green is permitted, not yet started. And you'll see there is an enormous amount of inventory currently under construction. That means that the ratio of houses under construction to sales has shot up and is the highest since this chart began. And that has to be negative for US house prices. So new homes months of supply is very elevated at about 9 months of supply. But what's really interesting is that house prices, they're down a bit, but they really haven't started rolling over yet. You'd expect them to retrace a lot of the extraordinary rise they've had since the start of the pandemic. So in summary, the US housing market is weakening, but mainly in home sales, not in prices. Reminder, the housing cycle is a volume cycle rather than a price cycle, precisely because house prices are sticky. There's a record amount of US housing under construction, and that will hit the market over the coming year, and that should bring the housing market down further. Okay, on to other charts, Richard.
So one of the things we've spoken about previously is that US corporate profit margins are too high, and the share of profits that go to wages versus shareholders has grown substantially over the last few decades. And a reversal would occur when prices that corporations can charge, businesses can charge, don't go up, but they have to pay their staff more. And that obviously results in a margin squeeze and less corporate profitability. And if the S&P operating margins fall to the long-term average since 1993, they've got about a 30% decline ahead of them. And that would presumably result in a average 30% drop in the S&P, all of the things being equal. Yep. So the prices of these companies on the S&P are really very vulnerable to this decline in margins. This chart shows that worldwide debt-to-income ratios are highly elevated. So back in 2000, they started off, generally speaking, these countries, they all started off on this chart around, let's call it around about 100 for the sake of simplicity, household debt to income ratios. Norway's debt to income ratio is now 225. The UK is about 125. Australia and Sweden are very high. Canada's pretty high. And only really the US has only very slightly up, I would say. The Eurozone, the Eurozone is up fairly significantly because it started around about 80. But some of these countries' debt to income ratios look to be really unsustainably high. And I'm looking at basically Norway, Australia, Sweden, and Canada.
Yeah, absolutely. In the case of Australia and Canada, you've had enormous property bubbles. And as interest rates rise, something's got to give. So we talk continually about the UK, Eurozone, and the US, but elsewhere in the developed world, rising interest rates could have a huge impact on the economy.
So this sort of reflects the previous discussion we've had. The UK economic recovery from the pandemic is weaker than others. So we went a deeper slump during the pandemic, and our recovery back to pre-pandemic levels. I mean, if you look at the red line, we didn't actually start in a great place, did we? We have slipped to bottom. And this is an issue that the government really needs to get a grip on now. And I think Jeremy Hunt is giving a speech today, but they've reduced tax relief on R&D, which is punishing the high technology sector in the UK. Everything they do without really understanding the consequences of their actions on the economy. I mean, the UK is, as we said, it's entering a state of stagflation. It's difficult to get out of. The era of deglobalization began with the GFC, which of course was now 12, 13 years ago, which is quite interesting. And obviously it's accelerated post-pandemic.
Yeah.
And that is also a contributor to inflation because production becomes less efficient. China's lost its wage competitiveness, which is an interesting chart. So it is really pretty much on a par now with the US.
So your point about the deflation by outsourcing to China and global trade, I mean, basically, China's lost wage competitiveness. And so that doesn't work anymore. Yeah. So when we look forward, you can see we're entering a new era in which the deflationary effects from globalization will no longer be there.
And also, a lot of the outsource is being resourced, and the resourcing actually requires new plant to be built to a great extent. And a lot of that new plant, it will be built using robotic manufacturing, I think. Hence my investment in robotics.
Very good, Richard. Well, you have to keep us updated on how that's going.
Yeah.
Okay, and on to good news. And this is something I came across this week when I was thinking about putting in some solar panels. And the house here actually has solar panels on the roof. They're photovoltaic roof tiles manufactured in Wales, and they're made to be identical to slate. So you need to look quite carefully at the roof of the house, but it is mainly covered in photovoltaic tiles. They have twice the width of normal slate tiles. That is the only way you can tell. And so I'm actually considering putting these on the back of my house. And if we can tile the roofs of the houses in this country with photovoltaic tiles, that would go a huge way to solving the energy crisis, as far as
It's
I can see.
fantastic. And look a lot nicer as well, Keith.
Yeah, precisely. Exactly. The one downside, I should say, is that they are substantially more expensive than solar panels. But, we are getting there. The price will come down, new houses, solar roof.
Yeah. Very good.
Onto the equity checklist, Richard.
Thank you, Keith. So quite a choppy week, actually. The FTSE All-Share didn't do very much. Stocks Europe up a bit. The S&P 500 and the Nasdaq significantly up. This is sort of making Jeremy Powell's job harder. The topics Hang Seng also up, each up about 3%. Bitcoin, very good week, 10% up. The pound basically bouncing around about 1.24 level, and the euro US dollar also not moving terribly much. Dollar index is basically almost unchanged on the year, and the VIX has fallen. So the VIX, the sell the S&P on the basis that the VIX has bottomed idea has failed. I would say I exited my position. Actually, I don't know if you did yours, Keith. Right. I'd say it failed. The problem being that the VIX can bounce around along the bottom for a long time, and yes, retrospectively you can see when it leaps out of the gate, but actually at the time it's quite difficult to get that timing right.
Well, but to me it is sending a really strong sell signal now. 18.8, that's well below 20, and saying sell.
Yeah, but not yet, because I think the S&P may still have further to go, and this is not investment advice. I just think that it's very, very difficult to understand how the market thinks about these things.
That's all true, but I also think the market has convinced itself the Fed is going to raise by just 0.25% next week, and they've discounted that. And I would think whatever the Fed does, the S&P is likely to be disappointed.
So there's Bitcoin, there's the VIX, and US equities net earnings per share beats. It's very, very low. In other words, most companies are not beating the earnings per share forecasts.
Yeah, still the S&P had a good week. Doesn't care. Multiples
going up, presumably. US equities net sales beats. So, in other words, their turnover is less than analysts' expectations. And European equities have had this is one of these charts that you could only do with a computer, isn't it? Yeah. But apparently, if you look at that little red line over on the left-hand side, they've had the best start to the year since 1987.
Great. 1987 didn't end well.
But this is a problem, isn't it? It's not predictive.
No, that's true.
Well, maybe it is. Someone will say, yes, it is predictive. And we've had a strong rally in emerging market equities because of the weakening dollar. And the equity market typically bottoms 6 to 9 months before earnings. And earnings seem to be falling. The equity market is rising. So there is a little bit of a disconnect there.
Yeah. So I think it's way too early to be calling the end of the economic slowdown.
Yeah. And household aggregate financial asset allocations are 45%, which is actually sort of top-ish of the range since 2000, but definitely top-ish of the range.
Yeah.
And not terribly much cash.
Or bonds.
Yes. And Morgan Stanley's earnings model is forecasting sharp drop in corporate earnings, which of course should result in a fall in the S&P. Yeah,
the S&P currently doesn't care, but
under normal circumstances.
Yeah, we also agree with Morgan Stanley on this.
And the S&P is on the same price to sales multiple as at the peak of the dot-com bubble. It just isn't good, is it? That was the time of irrational exuberance of Alan Greenspan.
Yeah. Okay, on to commodities and energy commodities. And it was an indifferent week. Brent was up 0.3%, WTI down 0.2%. Gas prices continued to fall. In Europe, they're down a further 10%, last week, down 30% on the year. The UK down 8%, down 22% on the year. What's surprising, and we'll go into this, is in the US, natural gas prices fell a further 12% on the week and down 37% so far this year, which is only 3 weeks old. And they started the year at $4.44 per million BTU. They're now at $2.79. Big falls. Coal drifted off slightly, down 2.2%, down 8.7% on the year. Uranium was up 2.7%. Numbers specific to the oil market. Well, in the US, we had an inventory build of the best part of 4 million barrels on the week. And since the start of the year, we've had a build of 26 million barrels. That is not bullish for oil. It suggests that the US is oversupplied currently. And you'll notice we're no longer drawing from the SPR. US crude production was stable at 12.2 million barrels. The Baker Hughes rig count fell by 10 and is down 8 on the year. So that would suggest that US shale drillers are pessimistic about the oil price later in the year and are cutting back. So this is Brent, had a big bounce since the start of the year, and money managers have piled back into crude futures this month.
So just on your oil cycle investing process, Keith, where do you think we are in the oil market cycle?
I am neutral on oil at the moment, Richard, because I think there are two very strong trends counteracting each other. Yeah. Supply is very tight. We know that there's been a lack of capex and capacity is constrained, but at the same time, we're going into recession. Yeah. And recession means lower oil demand. And you know that oil suffers from very high price inelasticity. So changes in the price don't really affect demand very much, but changes in demand hugely affect the price. I mean, during the pandemic, of course, oil prices went negative. So if we get a slowdown in the US later in the year, which I expect to affect the global economy, then you'd expect the oil price to fall sharply. And I'd prefer to sit on the sidelines, frankly.
So you're sort of possibly you're waiting probably for the next 6 to 8 months.
Yes, that's right.
And then maybe reassess at that point.
Absolutely. And the thing is, my default position is that equities, in particular energy equities, are incredibly dangerous. And you only buy them when they seem a bit of a bargain.
Yeah.
And right now, they're not a bargain. So, there are better opportunities elsewhere. Now, one of the reasons that the oil market seems decently well supplied at the moment is Iranian crude exports have recovered strongly despite US sanctions. And Russian oil exports, and these are seaborne oil exports, are doing just fine, thank you very much, despite US sanctions. And we talk every week about US inventories because those are the numbers available to us. If you look at total global oil inventories last year, well, they were flat. So we were reporting declining US oil inventories. Global oil inventories were unchanged. And that suggests that the oil market was actually well supplied last year. The current rise in oil inventories in the US is unseasonal. The blue line is where we are now. And normally, at the start of the year, you should not be seeing crude builds, although the rise in gasoline inventories is seasonal. This is the forecast for non-OPEC liquids growth, so oil production, over 23 and 24, and you'll see that actually the world is reliant on the US, i.e. shale, for its growth, but the EIA is forecasting incremental growth over the next 2 years of around 2.5 million barrels a day, which is very substantial. And that is despite a lack of a capex investment. So I don't find any of that very bullish. Now, one thing I am puzzled by, and if any viewer has an explanation for this, please get in touch, is that drill ship rates are climbing substantially over the last couple of years, despite the recently falling oil price and constrained capex budgets. Now, that suggests that capex is higher than reported. If anyone has an explanation, please get in touch. Reminder, at $80 a barrel, oil companies do just fine, thank you very much. So this is the profits of the super majors. See, last year was a great year. This year, forecasts are still very good. Obviously, that will change if we get a recession and oil prices collapse. Okay, so these are European natural gas futures continuing to drift off. Warm weather is coming. We're going into the spring and then summer, and you'd expect gas prices to drift off further. But total EU gas flows are about a third below their pre-war levels. So you see, they used to be around 10,000 gigawatts a day. They're now what? 8,000? So supply is lower than it was. And if you look at LNG pricing, well, LNG prices are expected to peak each winter as the EU sucks in a load of global demand to replace its flows from Russia. And these are UK natural gas futures, again, drifting off. US natural gas futures. Now, I think this needs some explanation. This has been an enormous fall in US natural gas prices from September. You're talking about 9.5 to under 3. It's a huge fall. And that has occurred against a backdrop of actually natural gas storage in the US, which is below its seasonal norm. So these are data as of December, and you'll see that gas stocks are below average. So the background is that both production, which is the top, and consumption have been rising. So this is production has been rising despite a falling rig count. This is the falling rig count, and consumption has also been rising. Although when you look at consumption in the power sector, that appears to have peaked as renewables are becoming the marginal electricity producer. So one area where consumption has been rising is LNG exports, and the Freeport LNG liquefaction plant came back online yesterday. Thank you to Simon W. for showing me this long-term chart. And you see that generally the trend in US natural gas prices has been falling over the last 25 years. And it all suggests that a market which is in structural oversupply. Now, I've read the commentary, and the commentary seems to be that traders are expecting high gas production to lead to problems with gas storage later in the year, and hence they're driving down the price of natural gas in the US. But you don't see any indication of an excess of supply right now. We'll just have to watch this space. This is coal price, uranium, flat, ticking up this week. And one thing I had missed is that Greta is now pro-nuclear and has quite rightly been criticizing the Germans for closing down 16 nuclear power plants and then replacing them with coal. And these are the nuclear reactors under construction. Now, obviously, one nuclear power plant can remain under construction for quite a long time. So this probably overstates how many are being built, but there has been a bit of a revival. And on to industrial commodities, Richard.
Thank you, Keith. So, aluminium continuing its new year run. Cobalt has unchanged. Copper didn't move very much in the week. 90 chromium, iron ore up another 1.2%, and probably still due to the reopening of China. Lithium unchanged and neodymium unchanged. I think I read this morning, actually, I was reading the lithium market is going to continue to be in deficit until at least 2025. Nickel up 5.6% on the week, which is a chunky change, and tin up 6% on the week, and 25% year to date for tin. Ferrovanadium unchanged, and zinc up 17% year to date and nearly 1% on the week. So generally speaking, industrial metals are having a good start to the year.
Yeah.
There's aluminium, cobalt, copper.
Well, I've put in the 5-year chart for this because copper has climbed up back towards its highs.
And given the forthcoming presumed supply deficit, one would expect it to go above its previous highs in time. And not necessarily following a straight line path either.
No.
So caution required. Chromium, iron ore.
Had a good run.
Yeah. Lithium, but on a longer term graph, it's just bouncing around its top. Neodymium, nickel. Nickel is another one that's forecast, I think, to go into deficit. Tin.
Yeah, tin had this extraordinary bull run last year, and well, it's back.
Yeah, so the GP graphics processing units are being manufactured, Keith.
For your NVIDIA investment, I take it.
I like to think so.
Yeah. Well, reminder to viewers, what's driving the bull market in tin is the environmental standards that have come in removing lead from solder. So lead used to be about 40% of solder. Tin is now best part of 100% in the solder. So you had big marginal demand for tin, which is actually quite a rare element.
Ferrovanadium and zinc. So precious metals, quiet week for precious metals really. Gold 0.4% on the week, 5.5% for the year. Silver down 1.5% and not very much change on the year. Platinum down about 6% for the year, half of which is last week. Rhodium unchanged, and palladium down 5%, 7% for the year. And I guess that we're seeing that world vehicle manufacturing is down. Some of that vehicle manufacturing is now electric vehicles, so presumably demand for catalytic converter metals has dropped.
Yes.
We have gold, a very nice run since November. Silver, same thing. Platinum, the same actually. But rhodium, which hasn't, and palladium.
There's a big difference between the catalytic precious metals and the monetary ones. Exactly. Monetary ones doing much better.
Yeah.
Okay, on to rates. Thank you, Richard. So we had no change in base rates. Reminder, the FOMC meet on Monday and Tuesday next week, and then the Bank of England meets on Thursday. We had falls at the short end in the UK and rises at the long end. So the curve flattened. In the previous weeks, the 50-year had come down sharply and it's given back some of those falls. Big action was in the Eurozone, where the reassuring GDP numbers and economic forecasts led to a sell-off in 10-year bond rates. So the Greek 10-year rose by 21 basis points on the week to 4.2%. The Italian rose 38 basis points on the week to 4.15%. And reminder, Christine Lagarde has stated that she thinks Eurozone rates could rise by another 1%. And she is committed to getting Eurozone inflation under control. Now, in the US, credit conditions have been easing despite falling PMIs. So the red line is the option adjusted credit spread, and it's an inverted chart. So line going up indicates easing conditions and PMIs are dropping. So there's a big gap between the two, and you'd expect that gap to close somehow. So credit conditions in the US to worsen and credit spreads to rise if PMIs turn out to be correct and US businesses are not doing so well. Now, when we look at US inflation expectations, there's really come down. So this is the 10-year break-even rate, and you see that inflation expectations in the US for the next decade are basically very close to the Fed's target of 2%. So the market believes that inflation has actually been transitory and that the Fed has got inflation under control. And if you look at the 5-year forwards, what I find really remarkable is even when inflation was well above 10% earlier in the year, the 5-year forwards peaked at 2.7%. So the Fed has still got a lot of credibility, and by raising rates quickly, it has retained the confidence of the market. And reminder that if we are right and there is a recession in the US in the second half, well, the Fed tends to cut rates hard during a recession. This is the amount of rate cuts during previous recessions. They are big. They basically cut pretty much to zero. So what will happen later in the year if the US goes into recession? Okay, so this is the UK 10-year. Has that peaked? Let us hope so. This UK 30-year, the same. US 10-year, German 10-year is still rising. Notice how much lower the German 10-year is compared to UK and US 10-years. Italian 10-year rising again, and Greek 10-year also rising again. Any change to your views on different asset classes, Richard?
No, I would say not, Keith. How about you?
Well, I'd previously had energy commodities as a sell, and somebody queried me about that, and I said, yeah, neutral sell. Essentially, I only really buy energy equities when there is a panic and they represent great value, and that is not currently. So hence, I'm sitting on the sidelines. Long term, I'm very bullish on oil, but over the next year, who knows? And concluding comments. Well, we've had an absolutely enormous bounce in equities, and I just don't see how the fundamentals justify that, frankly. I think when you look at Bitcoin, I mean, everything has been flying on the usual January optimism. I just don't think that's sustainable. And the big news is, of course, the FOMC next week. What will they do? What have you been up to this week, Richard?
I had a reasonable week last week, and again, mostly because of, well, virtually entirely because of the continuing improvement in the price of my precious metal shares. So that's my my lucky position, I like to think. I haven't done anything, no purchases and no sales. There's only one graph I'd like to show people this week, which is the graph over the last 20 years of the British pound against gold. And it has gone up from £200 to nearly £1,600 in 20 years.
Yeah.
So it's gone up sevenfold, 7.5-fold in 20 years. And in the meantime, it's had some pretty big drawdowns. So in 2011, it went from nearly 1,200 down to 700.
Mm-hmm.
So, but in the long term, as a protection against the debasement of all fiat currencies, holding some gold is a very good investment.
Yeah,
doesn't mean but it is very much a long-term position, and the share prices, for example, will be cycling up and down through these price variations. So it's just an interesting perspective, I think, an interesting longer-term perspective.
Yeah,
and that's it. How about you, Keith? How was your week?
Well, first of all, Richard, absolutely congratulations on your performance. Fantastic. I mean, you know that return of 7% per annum will double your money in 10 years. And you're already up 9.3%. Absolutely amazing.
There is scope for it to go the other way yet, Keith.
I, on the other hand, had a pretty shit week as long bond yields rose, and I was down 1.2% on the week. I'm up 2.4% year to date, which means I'm way behind Richard and lagging the all share, but it's early days.
I would just like to say, Keith, yes, that last year the roles were reversed, weren't they?
Yeah.
Decidedly so.
And this week, I moved some of my cash. So we've talked about this previously. These are two short-term cash ETFs which have relatively low yield, but much better than the deposit rate. So I sold some of that, and I bought some TR24, which is an index-linked gilt, and we're going to go into that. I also added a bit to my longer-dated index-linked gilt position. Okay, so this is TR24, and it has a duration of around 14 months. So it expires in March 2024. But you'll see that its price has fallen by about 5% in the last 3 months, which is enormous. So you're then saying that the yield has improved by 5% over the last 3 months. Now, what's going on? Okay, reminder, how you price and calculate the value of an index-linked gilt. Now, the clean price is the price quoted in the market, and it's the price that excludes indexation and accrued dividends. And the clean price will expire at 100 on the maturity date. So if we go back to this chart, that is the clean price. And so it is trading currently close to par. The index ratio is how the index-linked gilt adjusts its price for inflation, and it's indexed to RPI. So every day, the index ratio goes up according to RPI with a 3-month lag. Some older gilts have an 8-month lag. And then the accrued interest is the coupon, which for the 2024 indexing gilt is 0.125% multiplied by the index value. Then to get the price in the market, you multiply the clean price by the index ratio and add accrued interest. So the price quoted on London Stock Exchange for the 2024 indexing gilt is around 100, but if you go and buy it, you will find you have to pay around 147 because the index ratio is about 1.47. So we know that there's a 3-month lag in the indexation, and RPI 3 months ago was running at 14.2% annualized. And so I was thinking that by buying the short-dated 2024 index-linked gilt, I would get historic inflation and a decent uplift. But you don't get annual inflation. What you get is the monthly change in RPI with a 3-month lag. And that is very volatile, actually. So this chart shows in blue RPI, and that's the index level on the left-hand axis. And the orange line is the monthly changes in RPI at an annualized rate. And we know that in October, so between October and November, RPI was changing at an annualized rate of 7.3%. And this is the index ratio calculation for TR24 for this month. You'll see that the index ratio is changing every day based on the rate of change between October and November. So during the month of January, we will get the change in RPI between October and November 2022, and that is 0.59% or 7.3% annualized. So if you'd held it on the 1st of January to the 31st of January, you would get a return just from the indexation of 0.6%. And we also know what the return will be in February, because it will be the change in RPI between December and November. And that is an annualized rate of 7.26%. Thereafter, the return on TR24 will be dependent on what RPI does. What the market is essentially saying is it's assuming that UK inflation is going to come down very sharply, because the break-even rate is about 3.4%. So we know we're going to get 1 month of 7% annualized. And going forward, how quickly do you think RPI, not CPI, is going to come down? So I think, actually, we've just shown you earlier some charts showing service price inflation in the UK is persistent. Inflation could be persistent, and therefore I'm likely to get better than 3.4% going forward. Any thoughts, Richard?
So is this it's a complicated calculation, Keith, isn't it? And is there a point at which actually investing in it is a bad idea because of the way inflation is moving?
If inflation seriously drops, so drops below 3.4%, this is RPI, then I lose. But
so that is a long way for it to fall from here, isn't it?
It is. It's a long way for it to fall, but also it expires at par in 14 months' time. And as a cash proxy, I know I'm already getting 60 basis points next month.
Yeah.
So, compared to other, short-term bonds.
So basically,
yeah,
it's a safe place to put your money.
Yes.
And you get a decent yield on it at the same time.
Yeah, and the yield is tax-free because it's comes as a gain rather than income.
Yeah, so it's really, as opposed to your other bond and gilt investments, which are speculative.
Yeah.
In the nicest possible way. This is not a speculation. This is basically, this is a safe place to put your money until you wish to reinvest it.
Precisely.
In possibly the oil market or whatever it might be.
That's exactly right. Yeah. So this is one of my speculative positions. This is the US 20-year plus Treasury ETF going nowhere. Hopefully that's a bottom, but I've been saying that for quite a while now. This is 2071 gilt. Didn't have a great week. 2068 gilt. They're all the same, basically. So I am waiting for UK inflation to come under control and to start falling, and the peak in interest rates. And as I expect the UK economy to continue slowing and the US economy also to continue slowing. I think the peak in interest rates is very much in sight. And I've been surprised by the fact that US long bond yields have not come down faster. We will have to wait and see.
Yeah.
Okay, that's it. Thank you all for watching. Please can you press like and subscribe to the channel. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.